But people need to look at where we are today and where we're going. Right now, this fight against inflation, we're still in a little bit. It's almost largely conquered. But it has caused a generational reset higher in yields. You look at the yield of the ag, 4.5%. Any active manager should be able to get you 5.5% or thereabouts. And then if you move out in the credit risk spectrum, more of a multi-credit, like our income fund, that's more like 6.5%. So 4.5, 5.5, 6.5, those are pretty attractive yields. In fact, you got to go back almost 20 years to find the ag yielding levels like that. So very attractive. Second thing is, we think that correlation is back, okay? Because look what happened. A couple months ago, we had the yen carry trade blow up. What did people do? They bought bonds. Bonds rallied like crazy. So we think that negative correlation, now that the Fed is normalizing policy and not kind of manipulating the markets by either stimulating or by inflicting pain on it in the inflation fight, Fed's going to get out of the way, and we're going to have willing buyers and sellers dictate the prices of stocks and bonds and the relationship, and we're starting to see that positive or negative correlation come back. And then finally, capital preservation. Just do bond math, right? We're at 5% type yields. You need a huge rise in rates to get a negative return again. The problem with 2022 is we started with like 1% yield on the ag, so any rise in rates was going to rip through and tidal wave the yield that you were getting. Now we've got nice tailwind from that yield that should propel us forward. Another thing I'd say is, we get this a lot. I don't know if you and your advisors are getting this, but should the weights of 60-40 be static, right? And we would argue no. Just like any investor, you have to figure out what's your long-term goals and strategic asset allocation, but also what's priced in right now. And when we look at a market where growth is clearly slowing, like the US grew in 2023, slightly north of 3%, we're probably going to grow north of 2.5%, 2.6% in 2024, depends how the fourth quarter comes in. And then next year, we're saying we're going to grow more one handle, like 1.7, 1.8%. So that's about our potential, but that's rapidly shrinking from where we grew the last 2 years. And you have to recognize that when you're growing slower, there's less room for error, meaning recession probabilities have to be rising. If you're growing at 3%, the economy can handle a couple body blows and stay positive. You're growing at 1.7, you get a few hiccups in the economy, you can easily go to recession. So you got a slowing economy, rising recession risk, bonds are priced the most attractive they have in 20 years, and then stock valuations are at all-time highs. So we might even argue, if you want to get me to get a little provocative here, that maybe the weights on 60-40 need to be flipped. Maybe 60% in bonds, given the backdrop of the economy I just mentioned, the starting yields, and the starting stock valuations. So that's kind of a view we have right now.
Well, it's interesting to unpack some of the things that you were talking about. When I think about 2022, worst bond market on record for the U.S. aggregate bond index, one of the things that happened at the beginning of 2024 is that the market was pricing in all these Fed rate hikes, far more than what we're going to have ultimately gotten. And when the Fed sort of said, hey guys, we're not going to be hiking rates that much, there was a big jump in yields at the beginning of the year, but the starting yield was higher, and so it offset those losses. And I feel like so many bond investors have been afraid of rising rates because they cause price declines. But now that yields are higher, there's a little bit more cushion there. And as you note, with yields being more attractive than they've been in 20 years, there are some people who now have to think a little harder about where they go on the risk spectrum with their stock bond split and with what they do in their portfolio.